Chinese stocks have recovered, and Tencent is at the lead of it. They're basically back to their all-time highs. With their earnings date coming up, is Tencent, in my opinion, a buy right now? First of all, Tencent is more of a service provider around everything online. They're heavily in games, fintech, and social media. Gaming, they're big. They're number one in China and globally by revenue. They own companies like Supercell, which are behind Clash of Clans, Clash Royale, Boom Beach, and they have stakes in many other gaming studios. We're gonna come to those later. Digital content, utilities, that includes stuff like WeChat. They're the number one social media platform in China with WeChat. Basically, everyone over there uses WeChat. It is the super app. For example, Elon Musk said, what does we want Twitter to become? Like WeChat. So that kind of gives you the idea of how big it is. Other stuff like QQQ is kind of like YouTube. They have a small cloud segment. It is not as big as, for example, Alibaba, but it is there. They have fintech, which is also kind of integrated in WeChat. And all of these segments are growing very well. They kind of group it together afterwards. Value-added services, which includes stuff like the social networks and the games, grew 16%. Now, especially international games and domestic games, they can vary a lot. For example, if a big game releases in that year, it can go up and down a lot. But Tencent has kind of a lot of games which are long-term play, League of Legends, Clash of Clans, all of those things, long-term going, long-term cash flow, not a one-time hit. Marketing services, that is kind of integrated into their social platforms. Those are also growing well. Fintech, slowly growing but very, very stable. And they are also making their own AI models, of course. But they're not as big in AI as, for example, Alibaba is. But you don't need to be. Not everything has to be AI. Tencent is fantastically positioned everywhere else. All these businesses have developed well. Of course, after the lockdown, there was a long time where the Chinese economy didn't grow, but Tencent was the one which came out of this really with the most growth, at least domestically. Their operating income has massively exploded because they managed to massively increase their margins. But that also means that you can't expect this gigantic growth to continue because the margins are limited. You can't go above 100% margin, really. So slowly this will ebb out over time is what I expect over the next few years. And then we're gonna only grow with revenue growth. But Tencent doesn't only operate with their own companies in-house, they're also known for making massive investments. And honestly, listing up all the companies is impossible that they have stakes in. But just so you know how important they are, their gaming division keeps buying new studios. They're investing in Ubisoft. They own 40% of Epic Games. They own 20% of Sea Limited. So they're also heavy in e-commerce overseas. They have a small share in Neo. They have a big stake in Snapchat. Just to give you an idea how much other stuff they own. Larian Studios, 30% of that. Those are the Baldur's Gate 3 guys. From Software, 16%. Krafton, 14%. Ubisoft, they recently upped that stake. Activision Blizzard, that was sold to Microsoft. Path of Exile, that is basically now one of their divisions. If you have more than that, it's basically your own subdivision. And a lot of other companies which we invested in. Paradox Interactive, one of my favorite game makers, they also own a share in that. Basically, if you have a gaming company, Tencent has their fingers in it. It doesn't need to have their name on it. They are buying other companies. That is their thing. Tencent is becoming everything over time. Especially when you look at purchases of intangibles, because a lot of the stuff is just IP, they're buying a lot of that. Licensing for the international studios, etc. Overall, when you look at their balance sheet, they have a bunch of financial assets, they have investments in associates of 307 billion yuan, 207 billion in financial assets. This can be cash or stock, publicly traded stocks, or privately held companies, in which they have 401 billion yuan. And they have already divested a lot. Over the last few years, they divested from JD, they spun off those shares to investors, same with Meituan. Now, when you look officially, Tencent is a bit in debt, 32 billion yuan. However, that is common with the Chinese companies. They have their cash usually in longer term investments. So while American companies have it in like US Treasury bills, which expire in 1 year, so it gets counted as cash on hand, they don't. If you include the longer term assets that they have in cash, that is 64 billion yuan, so they're heavily in the cash. So what you're seeing in Tencent is an accumulator. It's growing book value per share extremely fast. And even tangible one, excluding all the intangibles, despite them giving out massive stakes like JD and Meituan to their shareholders, special dividends, normal dividends, the book value per share is growing massively fast. And a lot of these investments offer total assets, long-term investments. Those are those investments in other companies, cash, all of this. So that is tangible stuff. And even if we just look at short-term cash, they still have a shit ton of money sitting around. Now they also have a lot of debt, but that is fine. Tencent can take on debt. They have everything. This debt is not risky. However, their net income, just like Berkshire, can vary a lot. Because they have so much in other companies, if these companies go up and down, especially the publicly listed ones, that is giant one-time hits or one-time positives. So the net income can vary greatly. Don't look at the net income for this company. Look at the operating income and the book value per share. And they're still rewarding you at the moment, buying back shares. Now they have slowed down the repurchases because the stock shot up and they're investing more in data centers. But free cash flow is still stable despite the giant capex increase, and you're still getting your massively growing dividend over time. So I don't see an issue in that. So where can we position Tencent? Tencent is the Berkshire of international gaming, Chinese social media, and the best thing is, Tencent is not a well-known name to regulators, so acquisitions are not hard to make. And they're not slowing down, they have the cash, they have the cash flow, and operating margins are back where they belong. Now then is the question, growth is slowly accelerating again. They're not gonna grow in 60% like they did in 2017, but it's just not possible. Tencent is too big now to grow at these numbers. Now how are we gonna value them? Can't only look at the PE because they have so much in investments. Operating income would be a better way. Now however that would ignore stuff like interest expenses, taxes. So to calculate this, I'll remove income taxes and interest expenses from the operating income to come to a kind of net income that excludes all the noise around the other businesses. That's around 65 billion. We would come out to around 155 billion yuan, which is around 22 billion US dollars. Now, because that wouldn't include the investments in associates, etc., if we take that all together, that's around 900 billion yuan, or 126 billion USD, which is what we're gonna deduct from the current market cap to come to our value. Now, the valuation of Tencent is a bit different, because what I did with Berkshire, which is very similar to Tencent, now I'm gonna get flamed a lot for this, but it's basically a giant holding company owning a lot of other companies with some integrated businesses. The integrated businesses in Tencent are way bigger, but it's still a huge factor of evaluation. And what you did with Berkshire is usually take the hidden earnings, so take their ownership of the businesses, so you get all the net income that's hidden in Berkshire. But for Tencent it's different, because a lot of the businesses they have are non-listed companies, or companies that are not profitable yet but still valued. So for Tencent, I just decided to do one thing. I take the current investments per share, I calculate that as flat deductible, and from here on you could just basically say, okay, the rest is irrelevant, but a lot of the money that they take goes into these businesses, so they would just be valued at the equity gains. So I took this into dividends. So basically the money they put into buying small stakes in companies is a dividend here. This is a very different counting from what I normally do, but it's a difficult business to value. Now I take 60% payout ratio, so that includes dividends plus investments into smaller stakes of companies. The growth rates are put at 15%. I think with the recent re-acceleration in Tencent's revenue, they can easily hold that with share buybacks. Might get a bit difficult if Tencent gets valued way more highly, because then the share buybacks are going to be less and less of the company. But I think they're going to easily be able to hit the revenue growth. Slight slowdown after that, 80 multiple. Yes, it's a Chinese company, but Tencent is a fantastic company. We come to 69.59 a share. With the investments per share together, that's an intrinsic value of 83 a share. Slight upside from where it was today, so you would get around a 10% return. But this all depends on their investments, and I'm pretty sure you could up this investment part / dividend part to 75%, then we would cut to a different value. Now what if it grows a bit faster, 17 for the next 5 years, 15 afterwards, and a 25 multiple. Then we come to 104 a share, with investments per share that would be 118. That would be a very good buy, but that depends on a heavy multiple. Not a heavy multiple for an international company, but for a Chinese company. However, with more and more money flowing into China, I think these are going to become way more reasonable. Now what if it goes really bad? Only 12% growth, 10% afterwards. Basically reverting back to COVID era times. And a 70 multiple. Then 53, and with investments on hand, 67 per share. Not a huge downside, it will be an around 8% return. So overall, Tencent, if you want a quality company, a compounder over time, at a good price, way more decent than a lot of other companies, especially because I think this is fairly conservative, I think it will be a great buy. Now, am I gonna add Tencent? Not right now. I still own Alibaba. This is kind of my China exposure. It's a way different business, but there is some China risk in there, which I'm taking with Alibaba. Plus, I'm not adding money to my portfolio because I'm currently in the process of buying an apartment, and that's gonna cost a lot of money. So what do you think? Write down below. Have a good day.